Hi, good afternoon to everyone. Welcome to Kotak Mutual Fund's monthly market outlook. Let's come to the global economy. Globally, we have seen supply chain pressure has eased as freight rates have fallen and supply delivery time has also come down. This, along with high interest rates globally across various parts of the world, has finally brought inflation on the downward trajectory. Across the globe now, inflation has started slowing down, but the cost of high interest rate is reflected in lower growth. IMF and World Bank believes 2023 growth rate will be lower than 2022. Central bankers are doing a delicate balancing. While they have raised interest rates, they have not taken away liquidity by a great meaningful number. Investors who were very cautious about equity towards, let's say, middle of 22, now have slowly and steadily started moving towards equity, and that is reflected in the equity rally all over the globe. One big concern for world is China. Their debt to GDP ratio, what is officially known, is on the higher side, and there is belief that many of the state undertakings debt is not reflected into these numbers. More importantly, China is an investment-led economy and their exports have started slowing down. Foreign direct investment, which was the mainstay of China for years to come, has also started coming down over the years. Coming to the US economy, Fed has maintained a delicate balancing. They have raised interest rate at one of the fastest pace in its history, while they have been calibrated in removing liquidity by shrinking their balance sheet. After adding almost $5 trillion, they have withdrawn just about $800 billion. US inflation, thanks to the efforts of Fed, has slowly and steadily started declining on a headline number basis. However, core services inflation continue to remain in double digit. If we look at US inflation trajectory as of today, it is eerily similar to what happened between 1966 and 1976. There was a peak of inflation somewhere in the mid 75, and then there was a spike towards later stage thanks to the oil prices zooming through the roof. Currently, also scenario is becoming like that with oil prices moving up. Will American inflation bounce back like it bounced back in the 80s, or this time it will be different, is $1 million question. Unlike that period, right now, debt to GDP ratio for America is very, very high. It is almost comparable to World War II crisis level when debt to GDP ratio had crossed 100%. More importantly for US, as interest rates have gone up, their interest servicing cost has increased, and this has resulted into their fiscal deficit widening. On top of it, not only American government, but also American households are fairly leveraged. The total household debt is about $17 trillion. Mortgages account for $12 trillion. Auto loans account for almost $1.6 trillion. Student loans is another $1.6 trillion, and credit card debt is about $1 trillion. All Indians put together has roughly $850 billion of outstanding loan, which is lower than what Americans owe on their credit card. And, and like in India, loans on credit card, used car, and mortgage rates have zoomed up over there. In the past, American economy was always getting supported from the housing sector. But while the existing house owners are protected with fixed rate mortgages, the new houses are becoming unaffordable. If we see housing affordability index, it is at the bottom end. And if we look at new mortgage application, that is also at the lower level, clearly indicating that there will be less demand for housing at this point of time, at this level of housing prices, and at this level of interest rates. US yield curve have remained inverted, partly because of Fed has been able to regain its credibility on inflation fighting. But this inversion is one of the highest since Great Depression and the 80s depression. Fed's own fear of recession is at a 4-decade high. Clearly, Fed will have to leverage all its experience in balancing between rate hikes and liquidity provision to ensure that American economy does not go into recession. Even if American economy avoids recession, there is a debt burden for the next generation as debt to GDP ratio crosses 100% plus. In India, housing loan gets prepaid between 8 to 9 years. In US, student loans also don't get paid within 8 to 9 years. That's the difference in terms of debt servicing. In the Indian economy so far, numbers have been good. First quarter GDP came at 7.8%, little below RBI's estimate of 8%, but ahead of street estimate of somewhere around 7.5 to 7.7%. More importantly, from COVID period, which is September 19 to June 20, it's fourth quarter, quarter 4 2019 to second quarter 2023, the growth of Indian economy at 15% is one of the highest in the world. This puts to rest all the doomsday scenario which were building that India is not recovering from post-COVID shock. If you look at the headlines about Indian economy, they were by and large positive, though there are few dark clouds which are gathering. The first dark cloud is rising oil prices. Oil is now at $90 a barrel. Moment it crosses 3 digit, it could cause pain for Indian economy. The second is deficient monsoon. While July recovered and bridged June deficit, August has been the driest month in almost a century. Rural recovery, which is linked to good monsoon, has also come under pressure thanks to deficient monsoon. One big mainstay for India was IT sector, and thanks to a lot of challenges in the IT sector globally, we have started seeing IT companies hiring slowing down. These are all the dark clouds on Indian economy. In terms of past data, economic activity remains at all-time high level, with power consumption in one of the driest August reaching all-time high. GST collection remains comfortably above 1,50,000 crore a month, partly because of compliance and partly because of growth. Capacity utilization is now at 15-year average level, while the corporate leverage is at 15-year low level. Undoubtedly, corporate India is now in a good shape to start on the capex cycle. Government ahead of election has been spending on infrastructure, and last year was the first year, current year is the first year where government capex will be in excess of 10 lakh crore. Listed companies have lower leverage, and they have now started investing into businesses, into plants and machinery. Obviously, this is led by large industrial groups like Tata's, Birla's, Ambani's, and Adani's. The small and mid-cap companies have also started investing, albeit on a slightly calibrated manner. Private sector's announcement about new project investment has started rising. Hopefully, this pipeline will get converted into actual project on ground. The real estate cycle in India, unlike US, is fairly positive. It's coming out of a big slumber where higher interest rates and other things resulted into real estate coming down. Now things have started recovering. This will also aid investment cycle. India's banking system continues to remain in good state. NPAs are low. Credit and deposit growth is in double digit. Capital adequacy is reasonable. Consumer sentiments have started inching up. Earlier, urban consumption was recovering well and rural was holding it back. But now, rural and urban both seems to be converging. India's trade deficit from its peak in somewhere around mid 20 has started coming down significantly, and now it is averaging around 18 to 20 billion dollars a month. The trade deficit reduction is supported by increase in services exports. Global Capability Center has emerged as another lever for India's services exports. More than 45% of global capability centers are today operating in India. The dark clouds on Indian economy emanates from weaker monsoon, deficient monsoon, and compared to its long-term average, rainfall in August was one of the poorest. A large part of India is today having deficient monsoon, and September rainfall will be extremely critical for water levels to go up, for Kharif crop to reach its expected level, and also build reservoir water level for Rabi crop. The Kharif sowing season is same as per last year. However, there is some correction in cereals, but September rains are crucial in order to give boost to food production. Manrega demand has remained high, partly reflecting the situation on ground because of deficient monsoon. In fact, Manrega demand has surpassed COVID level, COVID year, and also last year. The other real challenge for Indian economy is IT sector's hiring going down. On a quarterly basis, IT sectors were recruiting between 50 to 75,000 engineers. Last 2-3 quarters, there has been net reduction rather than increase in IT sector employment. Oil continues to remain Rahu and Ketu in our Kundli from about $71 bottom Oil has moved to $90 a barrel. This movement has been driven by Saudi Arabia, OPEC, and Russia cutting their oil production. Saudi has taken a call to maintain cut in oil production of 1 million barrel a day for next 3 months. Clearly, by taking supply out, they are keeping oil prices on the higher side. Partly, Saudi's decision is driven by inability of US to dip into their strategic petroleum reserve. In the past, when Saudi had announced petroleum cut, US had dipped into SPR to deliver oil into the market. Now, unfortunately, the reserves have fallen so much that they don't have luxury to dip into that anymore. In some sense, despite the dark clouds gathering on our economy, we still remain comfortably placed vis-a-vis our peer group. Our story was good, but it is looking bigger and better as others started scoring self-goal. Russia invaded Ukraine and closed the door for investors. China is stuck with real estate bubble. Brazil has a communist government. Turkey has a loose monetary policy. South Africa has civil strife. All this has resulted into narrowing down of options in emerging market investment. Over a longer period of time, India growth story, notwithstanding oil and monsoon, appears to be bright. And going forward towards the end of this decade, India will be contributing as much to the global growth as whole of Europe. Coming to the equity market, one quarter full results are in line with expectation. 19 companies in Nifty 50 delivered profit ahead of expectation. 18 were in line and 13 were below expectation. It looks like Nifty is on its way to achieve about 1100 to 1150 rupee earning per share for FY 2025. As long as profit grows, market eventually follows. As Warren Buffett mentioned, stocks are slaves of earning power. As long as profit growth will continue in India Inc., market capitalization will follow. Profit to GDP ratio for India Inc. is now above its long-term average of about 3.7%. Right now, it is almost 4%. Valuation-wise, large, mid, small are either at their historical average or at a marginal premium to their historical average. Market cap to GDP ratio is back above 100% and also above its long-term average of 80% market cap to GDP ratio. To some extent, this premium valuation of India is justifiable as we have become defensive stocks for global investors. Our beta compared to global volatility, compared to global markets, has constantly coming down. FPIs, after having sold aggressively, has become aggressive buyer in India compared to other emerging market. One of the reason they are looking to add India on correction or on rise is the fact that in Indian market, entry is difficult and exit is easy. FPIs learned that between October 21 to June 22, when they had to sell equity to the extent of about $35 billion or 2,55,000 crore, they were able to sell it without any problem. Markets gave 10% correction and all the FPIs were out. But when they wanted to buy similar quantum of stock, market went up significantly. Going forward, what will move the market? Well, there are events. When will US Fed raise rate? When will they cut rate? What will happen to election 2024? What happens to oil prices? What happens to September monsoon rains? Will there be rebalancing in MSCI, upgrading Korea out of index? All these events will continue to impact our market. If they are positive, markets will move higher. If they are negative, markets will move lower. If we look at specifically in small and mid cap, they have done huge outperformance over large cap. Their weightage in overall market capitalization has increased significantly from their CY20 lows. There has been significant selling by promoters, including private equity venture capital fund, showing that insiders or promoters are encashing profit at this level of valuation. Our call at this point of time in market, like last few months, is that it is time to be a little bit cautious on micro cap, mini caps, and SME exchange kind of IPOs. It is time to be marginally overweight large cap and marginally underweight small and mid cap. It is time to maintain equal weight allocation to equity. And also, if you can keep some cash in portfolio to take advantage of any volatility coming ahead of election, that will be appropriate. Next slide, please. If we look at our equity funds on a rolling return basis, it continues to deliver double-digit return and also reasonable alpha over benchmark indices. The same is true in our hybrid and tax fund. If we look at point-to-point return in equity funds, again, double-digit returns are visible as markets are at near all-time high level, and alpha over benchmark indices is also visible in most time periods. If one invests on a systematic investment plan, again, returns are in double digit with alpha visible over most time periods. The same is true in our hybrid and tax funds. We also have a concept of smart SIP, where when markets are cheap, you can buy more, 2x of your intended amount. And when markets are expensive, you can buy half of your intended amount. This facility is available via our business hub as well as our website. This kind of tinkering on SIP versus smart SIP can enhance return by a percentage or two. Kotak FlexiCap Fund is our largest equity fund. It is one of the largest equity fund in the industry. It had a great track record over 5, 7, 10-year period. In between, it suffered little bit on performance as our investment call went wrong. But now, Harsha has managed to recover it well, and it is back to generating outperformance over its benchmark indices. This is notwithstanding the fact that we don't invest in offshore assets, and this fund remains a large cap biased fund with 75% allocation to large cap. Devender continues to manage multi-cap fund with Ellen. This fund has delivered more than 25% return and 8% alpha over its benchmark in last 1 year. Kotak Equity Opportunities is another consistent performer in our portfolio. Combination of large and mid-cap stocks, it has generated alpha over benchmark indices consistently. There is one fund which we have been managing for over 19 years, Kotak Multi-Asset Allocator Fund of Fund. It has grown 10 rupee to 169 rupee over 19 years, generating compounded return of 16% per annum. Our NFO right now for Kotak Multi-Asset Allocation Fund is on. It is leveraging on the past experience of managing this fund of fund for 19 years. In the fund of fund, where we have generated 16% compounded return for last 19 years, is investing into underlying equity funds, debt funds, and commodity funds. But since the taxation change happened, we have launched new fund offering. In this, we will be investing directly into equity, bonds, and commodities. This will give this fund tax status of an equity fund. The post-tax return of Kotak Multi-Asset Allocation Fund for a taxpayer will be better than Kotak Multi-Asset Allocator Fund of Fund. This NFO is closing on 14th of September. It has collected about 300 crores till today. We have received encouraging response for the same from investors. I will strongly recommend all of you to have a look at this fund, which is investing across equity, debt, and commodities. If we look at our NFO track record, Baring Global Innovation Fund, where fund performance has not been up to expectation of our clientele, in rest of the funds we have delivered reasonable performance. Coming to the fixed income market, well, right now, as I mentioned, Fed is trying to work out a delicate balancing. On one side, they are trying to bring down inflation and succeeding by raising interest rates. On the other side, they are supporting growth by providing liquidity. Globally, inflation driver has shifted from energy to housing. In local market, food prices, especially tomato, resulted into spike in inflation, and inflation zooming up to 7.4% last month. The deficit rainfall does not augur well for inflation. Pulses are showing less compared to last year. And if monsoon remains in deficiency, certainly there could be pressure on inflation number. The RBI has opted for a hawkish pose. They have kept options open for raising interest rates if needed. The liquidity, which was turning excess thanks to the FX flows, became negative first time in FY24 with RBI's incremental cash reserve ratio. Short-term rates have hit multi-month high as liquidity became negative for first time in FY24. The OIS curve is reflecting further rate hike. We believe the 3 to 7 year segment continues to look attractive from an investment point of view. Kotak Debt Hybrid Fund, which has about 25 up to 25% allocation in equity and up to 90% allocation in debt, is something which is an appropriate combination for people who are looking at stable return with little volatility. It has delivered fantastic alpha of mid single digit, low single digit over last many years. From a taxation point of view, Kotak Equity Savings Scheme provides fantastic opportunity where one can benefit from a return point of view thanks to debt and arbitrage opportunity, a stable return, and also post-tax advantage thanks to equity fund classification. Kotak Equity Savings Fund also has delivered consistent return over the years. And if your time horizon goes beyond 3 years, then not only the positive return, but also reasonably good high single digit return is increasing. Kotak Dynamic Bond Fund continues to outperform through deft maneuvering of interest rate calls. Our hybrid fund continues to deliver better upside downside ratio for investors, including in our debt hybrid scheme, equity saving scheme, multi-asset allocator fund of fund, and balance advantage fund. Compared to average equity allocation, the upside ratio is far more and downside ratio is far less, thus giving better upside downside ratio. On the interest rate side, a lot will depend upon what happens in rupee. Will higher oil prices result into rupee depreciating? Will there be a mysterious buyer, which in all likelihood is related to Russia, continue to buy Indian gilt or sell Indian gilt? What will happen to RBI in terms of raising rates or cutting rates? All these things will continue to impact Indian interest rate scenario. One believes rates could go higher. One believes rate could go higher if this scenario is turned negative, and rates could come down if this scenario is turned positive. As of today, we are in able command of RBI, who has navigated in Indian economy through choppy waters quite skillfully. On gold, we have been bullish since 2020. Sometimes call has worked, sometimes it hasn't. But we continue to remain positive view on gold. If we look at this chart, we have realized that gold prices have corrected as US real interest rates have moved higher. Now going forward, as US starts cutting interest rates, gold prices will get supported. Central banks, we believe central banks will be buying gold, especially what happened with Russian FX reserves. This year, their buying has slowed down, but OTC and other demand has picked up. It is quite possible that some of the central bankers are buying on a unanimous basis, and there will be some front who will be buying on their behalf, which is reflected into OTC and others category. This is another way to look at gold valuation vis-a-vis dollar. If we look at US government holding divided by their dollar issuance monetary base, then based on their historical pattern, one can figure out whether gold is overvalued or whether gold is undervalued. As of today, relative to dollar printed, gold looks undervalued.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.